Good afternoon, everybody, and welcome to the January 12th, Tuesday afternoon edition of Bull Sessions. My name is Mark Robertson. I am joined here by Ken Kavula and our special guest, Kim Butcher. Say hello, Ken and Kim.
Hi, guys.
Hi, everybody.
We continue to make good progress to get through the winter in the northern climes, and Kim is struggling away at, as she recently reported, 76 degrees down in Florida, which has to be substantially better than Evansville, Indiana, at least up from a thermal standpoint.
Exactly.
All right, so let's go ahead and get underway. A few things we want to cover. I do want to bring us mostly up to speed on our Groundhog Challenge. That's our stock picking contest that runs groundhog to groundhog, and looks like we're in for an interesting finish this year. Ken and I are going to cover our recent discovery that Forbes snuck back in and is competing with Ken and I for the Best Small Company thing. They released it in December, so I had to throw some Santa caps on the trick-or-treaters, and we'll try to decide what Forbes is doing and basically take a closer look at their recent offering for and as a source of ideas. We'll talk a little bit about cash flow triggering, some perspective on Amazon and Tesla, and I don't think we're going to add to the library today, but we will be kind of rounding that out here over the next few weeks, probably only making discovery editions after that. All right, you guys all know the disclaimer. No investment recommendation is intended. Nothing here should be taken as a suggestion that you should buy or sell anything. That decision is yours and yours alone. Please do your homework. Everything we do is for education, and more specifically, the demonstration and illustration of the philosophies, methods, techniques, and analysis mousetraps that are used by the modern investment club movement, whether it's the National Association of Investors / Better Investing or our interpretation of the same here at Manifest Investing. All opinions are our own, and if we do own something that we are talking about, we will attempt to remember to bring it to your attention. Our roundtable, again, 10.5 years in the making, 18.5% annualized returns that are beating the Wilshire 5000 by 5 percentage points, and we are just enjoying that immensely. If you'd like to know more about that webcast, it's always the last Tuesday of every month at 8:30 Eastern Time. It's free. It's wide open. Invite your friends and family. It's a source of ideas and the sharing of that which we do. You can send an email for a reminder to nkavula1@comcast.net. If you'd like copies of the slides, or if you have follow-up questions or suggested topics, things that you'd like to see more about, send me an email, markr@manifestinvesting.com. All right, just kind of our standing bullpen here. Today, I think we'll take a closer look at the Groundhog Challenge current status report. Like I say, it's looking like it could even be a photo finish on a couple of fronts. We discovered the Forbes Best Small Companies had been released early in December, so we want to take a look at that. I do want to take a brief look at just some thinking out loud with using Amazon as a template, but this notion of when can you start to take one of these companies more seriously, again, nested in the concept and the context of the types of things George Nicholson was thinking when he required a number of years of demonstrated history for companies. A few more thoughts on Jeremy Grantham. And like I said, there are other topics that we will be covering in future weeks, but we continue to maintain them on the queue, and we will be coming back to some of them very soon. All right. I think most everybody here in the audience is familiar with the Groundhog Challenge. It is 14 years in the running. It's a stock picking contest that we run from Groundhog Day to Groundhog Day. Groundhog Day, by the way, is our national holiday. It commemorates the day we were formed as a business back in February 2004, 2005. It gets blurry. Something back in that time frame. We started the Groundhog Challenge pretty close to the beginning of that time frame. And the reason that I put this slide up here, again, just to underscore this notion of it is a bunch of friends trying to help each other do better. But even though we run the Groundhog contest year in and year out and watch the annual results, we're actually as much or more fascinated with the long-term results. And what you're looking at here is that super investors of Warren Buffett's Graham and Doddsville type presentation of time across the x-axis from 3 years to 15 that you can see here. So number of years participating. So the x-axis is the number of years of participation in the contest, and the y-axis is the relative return. You should read that as excess return, or simply how much is that individual beating the market by over that time frame. So the one that kind of sticks off the charts, we're going to be talking about them again here in a few minutes, Broad Assets Investment Club out of St. Louis. They've actually won the contest, I believe, at least 3 times in the last 8 years. And in their 8 years, they've beaten the market by an average of 14%. 14 percentage points over the years. That is just off the charts huge. You can see some of the other participants in the roundtable that we do, that monthly webcast that we do. McManus is holding down the fort there, and there's a number of other names that you will recognize clicking along and in this club of market-beating participants. And one of the things that we find fascinating is that people in the Groundhog contest, this is also true for the Mid-Michigan contest. Now, Ken, I'll let you elaborate on that. Doesn't seem to be a lot of fence busting or swinging for the fences in a lot of the annual portfolios, or you really can't accomplish this sort of thing year in and year out. Is that basically your witness too, Ken?
Absolutely, Mark. People stick pretty closely to the up, straight, and parallel model, and I will notice that in a 9 or 10 stock portfolio that they send me for an entry, they might have one stock in that group that is obviously something that they're hoping is really going to click together. But the vast majority of the portfolio is full of stocks that anybody can analyze and come up with a par value for. And our winning portfolios are amazingly full of just everyday stocks that everybody's heard the name of, and they don't have to move to the Teslas and the the way overvalued stocks. They stick with stocks that they know and that they can evaluate, and they tend to win the contest. We have a couple of clubs that are really good at dealing with this thing you're going to talk about today, which is kind of analyzing early stage development companies, and you'll see those companies flow into a couple of portfolios. The clubs tend to talk to each other, and you'll see a new name pop up. And I can bet you when you see a new name pop up in 3 or 4 of the clubs, it's a name that I want to take a look at real carefully and real quickly, because I don't know, 7 times out of 10, it's something that's kind of exciting.
Yeah, and we are, in fact, we'll even do better this year with some of the resources at our fingertips that we haven't had in the past of, catching some of those new names and some of those new discoveries. A topic between now and February 2nd that's an absolute must is, well, one, just basic screening stuff to look for ideas. But I do think we owe the Broad Assets Investment Club another nod in this, perhaps a little bit of exploration of this topic of what we have referred to as launch pad investing. And they basically do always seem to have a company or two in their portfolio that's kind of hovering around zero earnings that is projected to go off the charts. And a couple of companies have done that for them, over this time frame. And it's just a very compelling thing to think about of, looking for those companies that are positioned to take off just in case they do take off. And we'll see what they come up with for this year, but it's been a lot of fun watching that over the years. We also love to see some of those newcomers that are rolling in. You do have to participate for a minimum of 3 years. So we're going to see some interesting names joining this list at the end of January, going into next year's contest. Here's your invitation for 2021, because we will run Challenge 15. And there's our mascot on the right. But we do believe a number of core principles. And like Ken said, we encourage people to send us a minimum of 5 stocks, maximum of 20, because, again, the benefits of going much beyond that are kind of crazy. Maybe we'll even publish a little article about how you're more likely to win if you trend towards that 5 rather than the 20 end of the spectrum, because diversification does work. It delivers more stable performance, but in general, a lower average. So we take $1 million and divide it up depending on how many stocks that you pick. So let your stock selection engines get rolling. Kim, get out there and you find those undiscovered opportunities. And you can email them to me between now and then at mark@manifestinvesting.com.
Ooh, should I mail them to you or keep them to myself and turn in my dashboard like on the 28th of February?
28th of January, I hope we'll disqualify you. All right, so let's take a look at the current results. These are the semi-official current standings, and these will not match up with the dashboards exactly because a couple of major reasons. First of all, I finally caught up with some of the Tesla and Apple splits. Also caught up with the cash that became available to many of you with the sale of Biospecifics Technologies, the collagen story that many of you bought into and prospered from greatly, including on the real dollar side of things. But Marie Frank, one of our small company champions, she's always sending us ideas. She's on the leaderboard at the #1 position and flanked by Ken Mobley of Harrisburg, Pennsylvania, and Bharath Ariana Yagapuram from, I believe, Houston. I believe we met him in Houston, Ken, along with a few other names. So you can see that there's pretty much a opportunity for a photo finish at that top position for the individual selections. Now, the broad assets, they are winning the group category again with their 1,000,009 showing. They do have some competition this year from those other clubs. Cool Kids is actually Herb Lemkool's family. I believe children and grandchildren, might be just grandchildren, but they're definitely in the running, along with an upstart bunch in Indianapolis, Lunchtime Investors. And Ken has a couple of entries on here through the Wolves and the B.I. Baker Model Club. And in fact, his family club is just off the list. And I would point out that the 4 Knights of the Round Table are all within $100,000 of each other, all clustered at 1.4. So they're just off of this chart. But notice that 80% of the people that are playing along this year are beating the Wilshire right now, with an average result of 43.8%. On the upper right, you see some of the behind-the-scenes accounting. That, again, is current data. Could even be intraday pricing in some of those cases, because I was doing it earlier this morning. You can see Marie Frank's selections. She's not bashful about technology, but she benefited greatly from I think that's Livongo Health, and their conversion into Teladoc. And that actually threw off some cash also. But some pretty good results across the board for Marie. The Broad Assets Investment Club, again, you can see some fairly conventional stuff there. You can see, we were talking in the session beforehand, Biospecifics Technology was cashed out at $88.50. So that basically becomes a cash entry on the Manifest Investing dashboards. From top to bottom, they did manage to have a position in Moderna before having a position in Moderna was really a thing yet. Be interesting to hear some of their thinking on that one. One of the leaders in the vaccine contest, but in general, some pretty good fairly familiar household names amongst many of those tickers on the list. Your thoughts, Ken?
I'm just this Livongo Health. A couple of our clubs rode it to victory in our latest contest as well. Where they found that name as early as they did, I wish they would have shared it, is all I say, because it certainly was a huge, huge move up in a very short amount of time, and especially after Teladoc decided they were going to buy it.
Yeah, it showed up in a number of portfolios, so it's been kind. So I do look forward to, we'll share this list every week between now and February 2nd. This could be one of those years when we have a finish where it isn't decided until the last day. Many of us remember fondly Groundhog 2 when Ken and I were battling it out on the final day, and then by some mystery of accounting, I edged ahead at the last minute. So, well, Ken and I have not been in the number 1 or 2 slot since then, but we've done pretty well over the years. You can tell that from that preceding chart. All right. So that's where we're at. We will continue to keep this updated. If you go to your Manifest Investing dashboards, again, the numbers are not going to be exact because many of these are intraday entries, but they should resemble, and most of the dividends and stuff have been caught up and will be caught up over the next few days and as we come down the stretch. By the way, last year's winner, Curtis Sears, is on here at number 16. So again, I just, when we do this sort of thing, and maybe I'm just, my eyes are glazed over, or maybe I need to put a bag over my head for a hyperventilation. I don't know. But as a statistician and an engineer and a person who understands numbers, I don't know how you fully discount, the performance of, people like Curtis Sears and the Broad Assets and these people that keep ending up on this leaderboard year in and year out. Bonnie Matter, she is always on this list, somewhere basically right there. Sandy Castor, they're there. And at some point, it's statistically significant when they just keep doing that year in and year out. All right, Ken, you want to take us away on what you discovered a few days ago and what we've been up to?
Well, I didn't discover it. My buddy Matt down in Houston, Texas, Matt Spielman, sent a post to the Manifest Forum where he indicated that he had just come across this brand new America's Best Small Companies list in Forbes magazine. It was, as we did a little research, found out that it was dated December 4th. It's labeled the 2021 list. So we're going to assume that maybe they're going to bring this list back and they're going to put one out right around New Year's Day, right before the holidays at least. And they're going to do it on a yearly basis. So we'll watch carefully for next year. What I started to do then was to put together a dashboard. Mark, could you click one more? Is that where the dashboard is? There it is.
Just the top.
I started to put together a dashboard, and it is a work in progress because, first of all, Forbes does not provide the tickers for any of the companies on the 100 company list. So the first thing I had to do was to go in and locate tickers for all these companies. And then I put them into Manifest with $100. And I think I noticed up on top there, I did this on the 7th of January, put $100 in. So that value column is what they're worth after, 3 trading days, 2 trading days, something like that. A couple of them have gone up, but most of them have moved in the opposite direction, at least near the top of the list here. Notice that the quality swings wildly, especially on these small companies with the amber color background in par. Remember that amber color indicates that the par might be too good to be true, might be a little bit overzealous in making their forward predictions, the analysts that are making the predictions. But I found that about 65 or 70 of the companies were actually already being covered in Manifest. So the top part of the dashboard, and you can get to it by using that URL at the bottom of the page there. Mark's going to go in and pull that up maybe.
I'm just going to show everybody we are sharing the names of the companies that have been added to the database in the weekly update, so you can see some of these companies. But
Okay,
here's
and then these companies right here, for the most part, I discovered were not being followed in the Manifest database for one reason or another. And I split them into two categories. Category one that didn't have any earnings of any kind, and I left those to Mark to determine which ones he wanted to put in the database. And then I asked him to include all the companies that did have some kind of earnings, even if the earnings were pretty bad or pretty short-lived, you know, like for 1 or 2 years only. So we picked up another, what's there, maybe 15 on this list, Mark, 15, 18 on this list right here.
Yeah, and we'll get most of the rest of them too. I'm just looking here. As you go down the dashboard, when you get down into some of these where you get just a kind of these are uncovered companies by the Manifest Investing universe. So I'll be going in and attempting to cover. I know we covered ATSG in the past, so that's probably a slam dunk. But there's a few companies left there to be dragged over the coals. I'll have that done within the next day or so. So you can come back and check out the dashboard. Notice
But I still think you're looking at the 75, 80 of the 100 companies. One of them is already off of the list. BSTC was on the list when it was published, but we do know that it's been purchased already. And I just noticed real quickly as we were going through here, another one has a purchase out for it, Sportsman's Warehouse. Looks like it's being purchased by Great American Outdoors. So we have a ways to go to pick some of these up, but I like to sort them by quality, Mark, if you would, real quickly. And there are a fair number of superb and good companies on this list. And if you combine quality and par together, I mean, Simulations Plus is a company well known to our community. Clearfield, I know nothing about. MYR Group, I know nothing about. And yet they have par values in the sweet spot, and they have quality ratings that I would consider investing in. An 80 or a 79 is at the very top of the second quintile, and certainly not anything to be sneezed at. So there are some pretty good companies taking a look at them even today in the way the market's been treating things and the valuation on certain companies. Even today, it looks like there's at least some good candidates for study on this list. And I would urge you to do that. And I would urge you to not discard companies in the good category when you're doing study work. Most of you that have a portfolio that's of extremely high quality, and you can afford every now and then to put in a slightly lower quality company if there's something compelling about it that you really like. You don't maybe make it a full holding. You don't give 15% of your portfolio to it. But these companies in percentiles from, let's say 60 all the way up to 80, those are still good companies and should not be discarded just because they have a quality rating that turned green rather than blue.
That's a good point, because sometimes it is an uphill slug against some of the blue chip companies to even get up in those upper quintiles. I know Matt's been really high on Green Brick Partners. I think Matt's on the call if he wants to raise his hand and chime in on that one. I know that he brought up Green Brick as a company that could be part of an industry study back when we were talking about companies like MI Homes, MHO, and Ken had recently selected D.R. Horton as a home builder.
Yeah, MHO is going to be a stock that I bring to Ticker Talk in a week and a half here.
Okay.
I really think it's a certainly extremely interesting and fairly small company, and I think it might be worth a little bit of looking at, as even though it doesn't have a quality that's blue like Simulations Plus or one of those others. I would how do I say this, Mark? I would look at Simulations Plus, and I would wonder where the analyst consensus PE of 98 comes from. It certainly doesn't match any SSGs that my clubs are doing. A couple of my clubs own Simulations Plus. I happen to own it personally. And we're doing analysis certainly not based on an average PE of 98. I don't know where a number like that would come from, but it might indicate extreme optimism on the part of certain analysts, or maybe it's only followed by one or two analysts, and one of them is just trying to do double duty with a couple of different ideas and not really thinking. I noticed Silk Road Medical up there with a PE of 115. That going with a quality of 11, I can buy that, but a PE of 98 and a quality of 85, those two things, they just don't kind of mesh in my head, at least.
Well, you nailed it, Ken. It's the analyst consensus that they've gone beyond being frothy to foaming at the mouth in some cases, and that's exactly what it is. They're certainly looking at simulations, and I'm not sure exactly what Silk Road does, but I imagine it's pandemic euphoria related. And you still have to run a business and everything else. Again, it is the analysts getting probably carried away. And
yeah, I think simulations would be a great one for us to do a prove on, Mark, just to see where the prove value comes in, because I'm certain that it's not hyper extended like this PE is.
Well, I'll make a note of that, and that's something we can take a look at perhaps next week to show that the projected return on value can help you to come to grips with that 98, and in fact probably make it not 98 anymore.
Well, and just to carry that point one step further, remember that 98 PE is very instrumental in coming up with the par value, so that when you're looking at a 98 PE and you see a par of 16.3, if you're mentally pulling that PE back down to maybe, well, even 45 or 40 is high in my book, but if you're pulling it down to maybe 45, then that's going to pull the par value down as well. Maybe this is not something that you would invest in tomorrow. Maybe it's not undervalued to this point, but it's certainly worth a study and some thinking and some, not being afraid to create your own model when you see that the analyst model seems to have one of the wheels missing.
Yeah, and we will take a look at that, and what you'll generally see is a more realistic projected net margin come to play in those also. So it generally fixes a lot of evils. Notice that the overall growth rate does at least check in at 12.6. They've got some real let's sort by the growth rate. Some of these here are fairly large companies. I wouldn't consider Weiss Markets to be a small company by any means. They're not large, but they are very mature as a company. We'll just leave it at that. And again, it's just a reminder that a list of small cap companies is not always a list of small companies. And that's the part of the thing that Forbes runs into with a list like this.
Yeah, one of the things that Forbes has changed in their rules for this list, Mark, and if you Google Forbes Best Small Companies 2021, you'll come right to the article that gives you the complete list and also the rules for what they're doing to pick these companies. And when they were doing this list half dozen years ago or so, they were capping the sales value at $1 billion, and now they're capping the sales value at $2 billion. So they've opened the door to a lot more possible companies in the setting of where they're going to look for these candidates.
Well, once again, Ken, we were way ahead of them. All right. There's the link to the article down at the bottom of the page if you want to grab that. Anything
Tracy's
else?
Tracy's asking, what does an asterisk on a company name in the dashboard signify? Tracy, that just means it's not in the main value line. That's the only reason for the asterisk. And I think you would find that the vast majority of these companies would not be in the main value line. In other words, you're not going to have an analysis written about the companies that have an asterisk. They're going to have just data, and they might not even be in the extended value line, which means that you'd have to pull your data from a different source then. I'm going to unmute Matt Spielman and let him talk a little bit. He must have heard what we were saying. So Matt, you're unmuted. Welcome. Glad to hear you.
Hey guys, good to be here. Sorry, I've struggled with my Wi-Fi coincidentally just after the green room ended. So hopefully my connection stays.
We could have been talking about you while you were gone.
Well, at least you recorded. I'll know about it later. I'll have indignation afterward. No, to get back to Green Brick Partners, because I haven't done a write-up in the forum, but I have been after all those buyouts that have happened in the fall. I put a lot of my bio-specific money into that and other money into that. You know, Ken has made great arguments for the home building industry in general, and both the shortage of or the reduced building that the U.S. has experienced ever since the financial crisis of 2008, and of course the migration to single-family homes that we've seen in the last year. As the oldest millennials turn 40 this year, and a generation bigger than the baby boomers. But Green Brick was really interesting, and there's a couple points. So just as a background, the green in Green Brick comes from the fact that Greenlight Partners, David Einhorn's hedge fund, was an initial investor, a founder, and still holds just under half of the stock. They are small. They have a significant operation in Dallas, and they're also significant in the Atlanta area. And they've been growing in Port St. Lucie, Florida, just north of Palm Springs, and Colorado Springs. So it's not just as good as the other home builders. You can see the growth. The sales growth is 22%. That's actually down from 30% in the last 5 years. But they're growing. They're running it. I'll say they're running it like a hedge fund, right? So what they do is they started in Dallas, but they go to look for. They find a target city with demographics they want. So growing city with young populations and low unemployment. They look for operators in that city that might be looking for a partner. So maybe an operator that they think might, want to sell their business after a while if it's private or whatever, and they make partnership deals. And eventually they come to own it, but they are not, and I'll say an operating company nationally in the sense that they have national floor plans or national strategies to go through. They're very much of the mind that all real estate is local, and they want to leverage not just local knowledge, but local in particular connections for contractors, for builders, for permits and things to go through. One of the other things besides the company that was really interesting to me, and I have kind of a sideline in this, but I don't have a way to express this. And the manifest data looks good, but Mark, you and I had talked, I don't know how long it was, 3 months ago. This looked terrible in a manifest dashboard because it has some baggage in just about every data set you look at from the company that held this ticker prior, which was it was a green energy company. It was a company looking to create fuels by the act of algae. so out of algae growth. And even when you go into your SSG today, you will see what looks like a terrible company that became good. But you have to remember that, I'll just say, remember that this company went public in 2015. So any data that you see prior to 2015 is actually a prior company and should just be deleted. Given that this is now a young company, but it looks very classically like a better investing style company. And it's interesting because you think about this easily visible once you know the story on an SSG, but any other sort of filtering or screening you might do has kind of kept it under the radar. And in fact, you could have bought this company for $11, and it did not have a significant decline in March. You could have bought it for $11 as late as June or July. So it's actually doubled in the last 6 months, but it hasn't doubled to a extreme PE. The dashboard PE was 10, and I think it might be at 11 or 11.5 right now. So it is not wildly overvalued, but it's a high grower in a niche player, and it's sort of that classic story of rolling up local players with the discipline of a national player and reaping the sort of revenue growth that you would traditionally see in like a retail story or something like that.
Yeah, and looking at the value line page, Matt, I'm surprised that all of this noise is even in, look at those
the deficit. And in fact, 2014 was actually a really good year for the end company because they sort of got bought out. But you see those deficits in earnings per share. That's not them. And again, I don't know how to express this as a sort of systematic way to find these companies, but to whatever reason that would discourage something from buying it, that means we can get a bargain now.
Yeah, and I mean, one thing that you can look, as an investor is look at that common shares outstanding line. There's something major going on right here between 5 and 31, and then 48. So my first reaction to it would be ignore anything before 2015 for sure on a first cut.
I think what's interesting about this company also is it seems to compete in two industries rather than one. It does the normal home building that you would expect, but it also does a lot of acquiring and developing of just the land, which it then sells immediately, and that's a big part of its business. So it competes with companies that would be listed under the real estate sector rather than in the consumer cyclical sector like the home builders are. So it's a little bit of a hybrid, and a direct comparison between this company and a MHO, for example, would show that this company has a lot more business segments attached to it than a traditional home builder might have.
Yeah, very true.
All right. Well, thanks, Matt, for bringing us up to speed on that, and we'll have to take a little bit closer look. All right.
I'm going to unmute Nick, who also has his hand up. Mark. Nick, go ahead.
Hi, guys. Yeah, talking about the high PEs that Manifest generates. Does Manifest generate those based on past earnings, or is the PE from analysts' consensus? Go ahead.
Yeah, it's being greatly influenced by the consensus.
Okay.
High target prices, high fair values, that sort of thing.
Right. Okay. Because I just pulled up an SSG on Simultations Plus, and looking at the quarterly, the PERT, what used to be called the PERT A, for the past 4 quarters, from November 2019 to August 2020, as far as like the percentage change of earnings year over year, at least for the past 3 quarters, it's been pretty much flat. In other words, it's been the same as it was a year ago. The point I'm trying to make is that when earnings go down, the PE goes up. So I didn't know if Manifest generates this PE or if it's just from consensus, because looking at the quarter to quarter, year over year, you could understand why for Simultations Plus the PE would be so high, because the earnings haven't gone anywhere for the past 3 quarters.
Yeah, and taking it a step further from that, looking at substantial upticks in earnings for next year and the year beyond. So that's
Oh, so
that's
you're
where
saying
that's coming from.
so the PE is coming from that projection in the future then as well.
Yes, it's influenced by it.
Ah, okay. Okay. All right. Great. Thanks a lot.
Thank you.
Thank you, Nick.
All right. So one of the things I thought we'd do for just a minute is kind of air out this notion of, we've been talking about the projected return on value for early stage companies. And if you go back to a few of the bull sessions over the last several months, we talked about Tesla, we talked about Amazon a little, and a few others. I just wanted to show a couple other pieces of information which help to kind of solidify this concept, or you can even call it context. What you're looking at here is the cash flow from operations for Amazon, and I think everybody in the room understands that that stuff on the far right over here is clearly very turbulent. Including negative cash flow down in here, and what we would think of as a head fake. The company's cash flow turned positive, but then went back negative. But the thing I want you to notice that we're looking at Amazon here, and as recently as 2015, it was a real head scratcher, and we'll reinforce that here in a second. But when you take a look at that cash flow trajectory, this is on a log chart, so just like a stock selection guide, only looking at the cash flow, that is a mind-numbing, actually very straight line for any business. And it's been that way for a very long time. And the reason I bring this up is we talk about this notion of using cash flow in place of earnings for early stage companies or deeper cyclicals. And this is a perfect example of that. I think it was appropriate to be more interested in Amazon somewhere in here. I don't know what exact time frame. I do think that it's incredibly consistent. And again, I'm just thinking out loud here with Nicholson's advice of looking for at least 5, if not 10 years of operating history. I'm looking here at almost 20. That 18-year period at 30%, 30% growth rate for their cash flow is absolutely massive. So again, maybe not getting interested at the point when cash flow went positive, because it can go back negative, but at some point they've earned no matter what their earnings are, the right to take a closer look or be examined a little bit closer. Now let's go ahead and throw in to show why that was not something that would be easy to do. Same chart. The blue line is from that previous page. You can see the head fake. You can see going positive on cash flow for the first time back in 2002, and then basically steadying out and getting on, some form of cruise control through that entire period. Earnings, however, continued to be a challenge. And again, Bezos would challenge anybody who brought this up and say, I can make earnings whatever you want. You guys have all heard the stories. This was a very, cloudy period in time. If you go back to Hugh's presentation back in that time frame to the Chicago audience, and I think he was more influenced by what he saw going on here than what was going on here, because Bezos basically was saying, I can make that number whatever you want me to make it. And, from a pure global sense, the trend through all of that is something like that. So it's just kind of an interesting look for me of looking beyond the earnings. Again, keep in mind that yellow line or orange line, whatever you want to call it, is greatly impacted by incidents and tax-related gymnastics. And the other one isn't, at least not as much. So it's just something to kind of to think about. That's one of the reasons that we put out these type of pictures for Amazon over the years. Again, looking at cash flow instead of earnings, and note the stability in the price to cash flow ratio. Again, the stability in that line that we're showing right there. Just some interesting food for thought. So with that in mind, when does Tesla fall onto the radar screen from either a cash flow or an earnings standpoint? Not until fairly recently. I mean, look at the head fakes. I mean, they broke through and were positive in cash flow 2, 3, 4 times, right? Well, ignore that one. But are they here to stay? With this most recent crossover into positive cash flow, they seem to be off and running. And I have no idea, but they appear to be kind of in that mode of reaching, somewhere along this point in the life cycle for Tesla. Again, they're not just an automotive company. We've talked about that quite a bit. But at what point can you be pushed into starting to take a company like this seriously? I think that moment is probably, now, plus or minus a few months. And here's another look at that same situation. Note the cash flow finally going positive on the value line report. So it can probably be subjected to the type of analysis that we do. With 2020 hindsight, if we'd have been looking at this in the same way a year ago, who knows, we might have bought some at $80 a share. It's now at $8.50. Notice that the most recent report was $400. You can't make this stuff up. So I believe it has to be overvalued at this point. From a projected return on value, again, this is just a rough cut. Projected return on value, I took the projected cash flow of $775 and divided it by the enterprise value. Again, that's the stock price, $8.50, believe it or not, plus the liabilities, which check in right now at $30 per share, and the cash in their checkbook, which checks in at $15. When you do the math on that calculation, you get a projected return on value less than 1%. That places it in the bottom 2% of all companies. Is it overvalued? Yes, it's overvalued. We knew that. Maybe not as overvalued as some people think, but just something to look at. And again, we'll be spending more time with this proof concept, obviously, but the average projected return on value right now is 5 to 6%, and this is well beneath that. Again, you can find 98% of the companies out there have a better projected return on value. Any comments or questions, Ken?
No, it's an interesting point of view, Mark. Really, and a lot to digest at the moment.
Yeah, and when Hugh and I were talking about this a couple of months ago, we were kind of blaming the psychology that is Elon Musk. You don't have to use the psychology. The numbers are there. This is too turbulent for most of us. It's just too turbulent, even outside of the eccentric behavior that was cited when we were talking about that time frame before. So just something to think about. All right, we had been talking about Jeremy Grantham's bullish bubble call, and we would encourage everybody to read that and read it under the premise that Jeremy's bullish a lot of the time. He's also got a pretty good track record over the years, but it's a good, I think it's an opportunity to read it in the context of understanding risk, especially if you're in any type of a capital preservation mode. Your thoughts?
Did you mean to say that Jeremy was bullish most of the time?
No, he's bearish most of the time.
I know, that's what I think too, but you said he was bullish most of the time.
Oh, that was just wishful thinking, I think.
Okay.
And
It's time for some more caffeine.
actually, I'm about a cup short on the day, so I appreciate that. No, and don't take any constructive criticism wrong here. He's one of my heroes. I mean, I spent time with him at the Morningstar conference a few years ago. He gave us that beautiful definition of quality that I'll link to in the forum thread, where he basically talked about companies striving for the right levels, and then basically delivering on what they said they were going to do. A really neat definition of quality, and some of the GMO mutual funds have done very well over the years. So good stuff. How bearish? Ken, this doesn't qualify as bull in any. I mean, this is their 7-year forecast for asset classes.
Since last Thursday, our last session, Mark, I have read and then reread his letter, and I've tried to digest this particular slide as well. And if you keep telling everybody every year that things are going to be a disaster, I think at one point you might be correct or partially correct. And that's where I guess I have to place Grantham and a lot of what he's said over the last 5, 6, 7 years, that if in fact what he's predicting is finally going to happen, he's lost out on an awful lot of upside in telling us to be afraid for as long as he's told us to be afraid for.
Yeah, I'm with you on that, and I go back, and maybe it's time to do a short segment on Chuck Allman. I don't know if you happen to remember Chuck. Chuck was even more bearish than Jeremy, and if that's possible. But Chuck Allman's approach to that was he used to keep 40 or 50% in cash all the time in his managed portfolios. He published the Growth Stock Outlook newsletter, which was had a tremendous track record, but he would load up on a bunch of local, I'm doing air quotes right now, Ken, neogens. He would find a few neogens that he could trust and count on, and he would invest in those, 50% of the portfolio in that kind of stuff, the neogens, and then another 50% in cash, and he would achieve these monstrously successful returns. And we should spend some time talking about that also, because you talk about doing things absolutely contrarian or with a different approach than 99% of the professional investors on the planet. Good, clean fun in any stake.
Maybe a lot of that kind of investing depends on what state you live in too, Mark,
Could be too. That landscape appears to be changing too. All right, so I'm going to put Allman on the board for a future emphasis. Simulations Plus, maybe a little bit more on Green Brick, just to show the company that it is. With that, I think we're getting pretty close. Yeah, we're almost up at an hour. I did update the library with the recent selections. I grouped Peter Lynch's 3 trilogy there together on the left, and for those of you that are looking for exciting people to attend a party, Ken added the accounting game and keys to reading an annual report. You really want to invite him to your next party.
Well, I don't think any of these are the kind of book you want to read if you want an exciting read. There's a couple of good reads in here, but none of these are to the point of a good solid mystery or something like that.
Yeah, and Kim, a couple of yours are real snoozers too, but they're really good. But man, you guys are helping me with my insomnia.
The problem with insomnia, and you start reading, you keep staying awake. That's my problem, because I start reading and I'm like, oh, then the 2 o'clock nap happens.
All right, so we'll probably add a few more to this and tend to chew it over time, but it's a pretty interesting collection of books, and I would highly recommend the audience seek out a number of them and check them out if they are new to you. So with that, I think we'll just go ahead and point out again that you can access these sessions. We record them and make them available on YouTube. If you search Manifest Investing, you'll find a page which looks something like this. I happened to capture this screen capture on the day after we had posted all 5 of our most recent conference sessions. So you see all 5 of those sessions on there. But go ahead and subscribe to that if you'd like to be notified at any time there's fresh content, and we'd appreciate that.
Well, Susan Macholik up in Wisconsin loves the accounting game, Mark. I'm getting a really nice comment from Susan. So.
Oh, yeah. Well, I'm not going to say anything to keep me out of trouble. By the way, Susan is in the club that is competing with the broad assets. They just have a longer track record, and I'll actually switch to that here in a second. I just thought, Ken, I couldn't let the approaching advent of Groundhog Day go without this picture and just a COVID's going to get in the way again this year, isn't it? We're not going to be able to
Oh,
swing by.
It might. Natalie and I are looking for a trip up into the Finger Lakes later on this year, maybe September or October or November. And maybe we'll drive through Punxsutawney on our way to the Finger Lakes, Mark, okay?
Well, that would be, sort of like a bucket list check off with an asterisk for me.
I'll get my camera out and take you some pictures.
We appreciate that. Okay, and just to finish the roasting on Susan Michelik, we'll just point out that they have the best long-term track record, and I actually was going to mention this earlier. I'm glad I waited. The Bower City Investment Club out of Janesville, Wisconsin. The really neat thing about them and their Groundhog entries is they use their actual club portfolio. So just think about what that looks like after 12 or 13 years beating the market by 6 or 7%. That's got to be a whole lot of fun for Susan and her band of friends in southern Wisconsin. A lot of good, clean fun there, I'm sure. All right, so with that, Ken, I think we can go ahead and field some questions. If there's anything you want to kick around a little bit more, any topics and questions for the future?
I'll tell you that I've cleared the question box entirely and we don't have any hands in the air. So maybe we should just, there's a question in the question box. Susan says 680K, which I'm assuming is the balance in the investment club portfolio at this moment.
Yeah, that's just her going ka-ching, and that's welcome here.
And I'll do a ka-ching also, Mark. The Mid-Michigan Model Club, which is the first club in Mid-Michigan, the first model club in Mid-Michigan, just passed the $1 million mark in its portfolio about 2 weeks ago.
Woohoo!
Yay!
Yeah, and I know you guys are running at what, 4 or 5% relative return?
More like 3.5 to 4.5. Yeah.
That's still excellent. That's excellent.
Yeah.
All right. So with that, I guess we'll say. Well,
we have Hugh in the audience, and Hugh wants to be recognized. So Hugh, you're unmuted. Go ahead.
Oh, you can hear me.
We can hear you now.
Oh yeah. I've been in the audience since just 5 after the hour. So glad to hear everyone's voices. Happy New Year.
Happy New Year to you too. Happy
New Year. Thank you again.
Hey, Hugh, any quick commentary on Bristol Myers or Eli Lilly of recent developments at Eli Lilly on Alzheimer's?
Yeah, Lilly has been working on Alzheimer's for some time now. Alzheimer's, I'd say there's probably about 150 drugs that have been tested on Alzheimer's, and pretty much all of them have died. I need to look into the latest news from Eli Lilly. Eventually, a drug is going to crack it, but it's proven to be a really tough nut. Regarding Bristol Myers Squibb, if you want to see an illustration of why I kind of like Bristol Myers Squibb philosophically, why I like the company and its approach, on Amazon, if you're a Prime subscriber, you can watch a documentary called The Breakthrough, and it's about Jim Allison, a Nobel laureate from Texas who came up with a novel way of conquering certain forms of cancer, autoimmune therapy. He was dismissed for a variety of reasons, including the fact that he has a very probably rich personality, which is one of those acquired tastes. But Eli Lilly, and particularly one or two champions in Eli Lilly, saw the value of what he was doing and were willing to take an enormous risk in clinical trials, and there are now hundreds of thousands of people alive thanks to those drugs and a whole slew of drugs which follow that approach, thanks to the initiatives taken at Bristol Myers Squibb. Very interesting documentary.
Yeah.
Bit off topic, but I thought I'd throw it in there because I just watched it.
Bristol Myers was up pretty handsomely. It was accumulated by Kathy Wood, which is a topic for another day. But
yeah, they're getting quite good clinical news right now, and it's all in oncology.
Hugh, would you repeat the name of the TV program again?
It's called The Breakthrough.
And you said you got it through Prime, right?
Yeah, Amazon Prime.
Okay.
There's also a book which is a really much better read. And Jim Allison, if you put Jim Allison, you'll find it that way. You've got it.
Hugh, we have an interesting question from Joe Whitaker. Joe wants to know, have you ever thought about assessing the threat that China poses to U.S. drugs?
Yeah, I mean, it's a really good question. That's Jim Allison in the glasses there, a younger version of him. But so one of the things is that most of the innovation on the planet comes from the U.S. And my personal experience in dealing with Chinese-based suppliers is there is a major cultural difference in how innovation is approached in China versus the U.S. If you give a project to most Chinese companies, the team there will carry out exactly what you tell them and won't do that proverbial outside the box thinking to move the project forward. All of the leadership on that area has to come from US or Western European companies. So there is a threat, but the interesting thing about China is it is becoming the victim of its own success. So there are examples now where I have bid on projects, and this wouldn't have happened 10 years ago. In fact, 10 years ago, it was unthinkable that a US supplier could beat a Chinese company on price. Doesn't happen often, but it is happening. And, it would not have been conceivable 10 years ago. And you would have been laughed out of the room 20 years ago, 15 years ago, if you made that suggestion. But it is occurring. So, yeah, there is a threat, but one of the downsides of this threat is as an economy becomes more successful, it has all of the problems of a maturing economy. If that's the question that was asked. Other than that,
Thanks a lot. He appreciate the answer.
Yeah, and there is still the issue in certain parts of the world, and I would include China in that score of kind of ambiguity when it comes to respective patents.
Mark, I don't have any other hands in the air. I don't have any other questions. So now's a good time for us to say, see you next week.
Okay. Best wishes and better investing, everybody. Take care.
Good afternoon, everybody.